Good morning, ARMR Insiders. Welcome to the morning call. Thanks for joining. Let's dive right into how we're going to trade today and what our investing posture is. So, as always, I'm sharing with you how I manage my own personal capital. It's the ARMR Investing Way. Basically, 3 stages. Build our whiteboard. That's where we do our fundamental work. We'll talk about what stocks are at the top of the whiteboard for possible inclusion into the portfolio if our risk monitor changes. And maybe a couple even before the risk monitor changes. Then we use our algorithms to drive our risk decisions on a day trading basis and an intraday basis and an investing basis. And we'll go over what those algos are saying. Take a quick look at yesterday's action on the day trading side. So I really want to highlight the most important time for us to put capital to work on a day trade and how we must maximize that opportunity. And then, of course, we use stop losses to protect it all. So, as with any of these conversations, I'm sharing with you my own personal approach. Take from it what works for you. Use it as a guide. Do your own due diligence. Make sure you have a risk tolerance that's set up for what we're doing. So what I want to try to do here, as always, is stick to what's the information, how do we make money with it, or protect capital with it. So we're going to have a conversation like that today. So step 1, let's just delve into the market itself. So I like to start with what our trading posture is going to be, and then we'll get to investing in a second. So what we want to do is we want to trade what we see. We don't want to rationalize it. We don't want to overthink it. We don't want to talk ourselves out of it. We just want to trade what we see. Okay. So what we have right here is a market that went from the top of the channel to the bottom, found support at the bottom of the channel, and has bounced for 2 days. Today's day 3. Really, today's day 2 because the reversal bar is the reversal bar, and then you have a day of rally and another day of rally, which is probably today. Those 2 days of a rally are classic counter trend type of things, and we have to see if it changes that. But we're going to get to that in a minute. That's more of our investing side. Let's just talk about a couple of thoughts top of my mind when it comes to trading correctly. All right. Position size is the key. Position size is so important. Okay. So what you need to do is find a position size that you can execute with over and over and over again without looking at your P&L. Okay. You don't want to stare at the P&L all day and have that change your process. You want to execute at a position size where you can follow the trade to its natural conclusion using the strategy. Whatever strategy you use, I'm going to share with you, as always, my strategy. I do that all the time, right? So in the morning, we have a live stream. We all go into the room. I share with you my screen and I say, here's what I'm doing. And I work with you on a process of what the strategy is. But even I fall victim sometimes to overthinking or changing the trade right in the middle for whatever reasons. We all fall victim. And I would submit to you that the reason that happens is the position size is just too big. Okay. So let's work on a position size where we can simply execute without emotion. Okay. I repeat, do not look at the P&L during your trade. All that's going to do is get you off the bus of the trade. You know where you put the trade on. I share with you what the stop is, so we know what our loss is going to be, right? And then I share with you what the targeted exits are. And then you, of course, follow whatever path you want and book your profits however you want. The funny thing about the P&L is that it'll follow if you execute the strategy correctly. Okay? This is what I want to show you just to wrap up this thought on day trading. For the ARMR Investing Way, the most important time of day for a trade to develop, what makes it most important? Highest probability of success with the perfect reward to risk ratio, okay? That happens between 10 o'clock and 11:30. We'll get an entry point between 10 o'clock and 11:30. And when I go look at crunch all the data, look at the algos, look at the trades, look at all my trades. I can go back whatever time period you want. 5 days, 5 years, anything in between. The best trades with the highest return and the lowest risk occur from entry points that happen between 10 o'clock and 11:30. We've got to be there for those trades. We can avoid trades in the first half hour, even though we'll miss some days because sometimes the market opens up and just skyrockets. We can avoid trades in the afternoon, even though there's some trades in the afternoon that'll work. But if you want to focus on the highest probability trades, they show up between 10 and 11:30. The other thing to do is we can manage position size. Smaller positions in the first half hour, smaller positions in the afternoon, maximum position size in that sweet spot. Okay? So let's go take a look at what happened yesterday, and then we'll get to the investing posture and sharing ideas of what we might be investing in. So I want to show you this trade right here. This is the S&P we're looking at now. So don't forget, this is a 3-minute bar chart. And we like to use the triple index ETFs. So we're looking at SPY, and we key off of SPY, but then we buy SPXL. And we trade it, okay? This is such a classic double bottom that occurs at 11 o'clock that it would be absolutely tragic not to make that money that was made yesterday. Tragic, because the reward to risk is at its highest right here on this 3-bar reversal, which, if you recall, ARMR Insiders, I highlighted that as it was happening during the day of trading yesterday. I said to you right there it is, 3-bar reversal at 11 o'clock on every index. So we had confluence everywhere, the S&P, the small caps, the NASDAQ. They all were doing the same thing, all in the sweet spot time. That's the position to put on. I don't care what your position size is at that point. That's the position to put on. All right. So in the morning, I tried this trade early. It popped up for a little bit, reversed. We ended up stepping out around a break-even trade there on that first trade. So sometimes what you do is you get this first half an hour sell-off. It goes above VWAP. You put a trade on and it just goes straight up. So it's worth trying that trade. But I submit to you that this entry point, from a statistical point of view, has a lower probability of success than this one right here. So we either A, avoid this trade, or B, this trade is at a smaller position size. You get out at break even because it doesn't work, pulls back, sets up the second entry point. You double the position or triple the position. The stop in this case is the low of the 3-bar reversal. Bang, bang, bang. Right here, closes above VWAP, put the trade on. Stop is right down here. So the risk versus the reward is optimal. See, the reward was a skyrocketing day. The risk was a small loss if it came and took out the lows here. Okay? Let's take a look at the day before. Same setup. Different day, different type of setup. This was a gap down implosion that set up a bottom right here at 11 o'clock. 11 o'clock. Never took out the low of this buy signal bar, which was right here. Never took out the low. Could have stayed with this trade all day. We traded it twice. We booked a profit here, it pulled back, we bought it again, took off. Okay. But theoretically, you could have your trade on and leave it alone all day. Never took out the stop. 11 o'clock. 11 o'clock. Now, there'll be some days it's 10:30. Some days it's 11:30. Could be in the quarter hours. And so I'll just leave you with this thought. The hour, the quarter hour, the half hour. Those are the key. Now, it can happen at 11:03. I mean, it doesn't have to be exactly on the number, but right around those whole numbers are when we get the best signals. The reason being, there's 2 incredibly important algos that run all the time in institutional trading desks. Volume weighted average price. We all know VWAP, but I think we forget about VWAP's twin brother, which is time weighted average price, the TWAP. Okay. Huge amounts of money are put out on a time weighted average price basis, which means an institutional say, buy me 1 million shares of Intel, and I want to buy it on a 15-minute TWAP. And every 15 minutes, the same amount of shares will hit the tape as they're buying every 15 minutes. Or they'll say, give me a half an hour TWAP. I want it to be finished by the end of the day. It'll just figure out how many shares have to be bought, cut it into pieces, buy it every half an hour. That's why this works. All right. So those are my thoughts on the trading desk. We'll be looking for these setups again today and every day on the ARMR Pro Live Trading Desk. Okay. It's going to be fun. We're going to keep making money. We've been making money this all year so far. We're going to keep at it. There's always more money we can make. We can always execute better. I know for me, I feel like in order to execute and trade correctly, you need blinders on. I'm not answering the phone until noon. No one's coming in my office. I'm not doing anything else. I'm sitting and watching the setups so when I get them, I can trade them successfully. That's key. All right, now let's go to investing posture. All right, so a couple of thoughts for you. So far, the rally that we're looking at is a classic counter trend rally. So we have the top form, the breakdown right to the uptrend, and an attempt to go back to the 50-day moving average. The 50-day is the key. So the market always tries to get back to the 50-day, and that's what's happening right now. And we're going to clear the 50-day on the NASDAQ at the open. The S&P stops right at the uptrend line and closes above the 50-day. Now it's going to go higher again this morning, attempting to take out the highs. All right. But I will submit to you that so far, this is a normal bounce in a broader top that's forming with volume declining, which is classic of a counter trend move. The key that would change our risk posture. So what's the information today? Risk monitor is still red. Gamma is still negative, although we've popped above it, but it's still negative. 2 days of a rally is typical in any type of correction. So it's what happens on day 3, which is today. And it's really what happens by the end of the week. So if we get a weekly bar that's positive, that could change the risk monitor, but it hasn't changed yet. And so what we're doing now is just working on our whiteboard, elevating names to the top of that board so we know where we want to go when the risk monitor changes. And I'll go over some names with you in a minute. But take a close look at what's going on. Look at the IBD 50, for instance. These things have been destroyed. They made lower lows and lower highs. They're going to bounce a little bit. That's normal. Okay, momentum index broke down from a huge a rising wedge. You can say to me, well, that's a double bottom. It may be, but we don't have that set up yet. Okay? It's not a double bottom yet. It's a market that's bouncing after a destruction, which is typical right around, this is the momentum stocks, right around the 200-day moving average. So you're going to expect a defense of the 200-day and the 50. That's normal. It's a question of what happens next and what happens by the end of the week. That's the information I'm sharing with you. That's what would change our risk monitor and get us a little more aggressive on the buy side. Now, I do want to share with you the ARMR algorithm. So this is a graphical representation of the ARMR algo, and I'm going to this is the NASDAQ over here, which you can see this little entry point got stopped out right here. This is part of why we're risk monitor red. So this is a 60-minute chart now. So the algorithm is based on 60-minute charts. We've written the algos are different for all the 7 different indexes we follow based on the volatility and those types of things. For each index, it's different, okay? But most importantly, the biggest and most important index to pay attention to is always the S&P, okay? S&P drives the bus. And the S&P has because it drives the bus, it's kind of interesting. It has a very lenient stop. We stay with the S&P as long as we can. So even though it drops below the 50-day moving average here, for instance, on a gap down, it's still long. Our algo says don't sell yet, and it ripped to a new high. Okay? So you can see this sell-off right here. These sell-offs here, this is important to try to, let me try to explain. The algorithms are written differently for different, IBD 50, momentum index, small caps, they all have different volatility components. And so they optimize out differently when you're building an algo. And without a doubt, the strongest algorithm, the highest probability of success that produces the biggest results is going to be the S&P if you're writing a strategy correctly, because it's the one that trends the most. It's got the largest cap names with the biggest volume. And whenever you're writing an algo, whatever has the most volume allows you to create the best strategy. Okay. And as you go down the volume spectrum, you get more whipsaw swings that force you out of positions because you have to protect capital. You can't let it implode. Just, example, the ARK funds, okay, or the IBD 50. I mean, the things drop 20, 25% in a matter of matter of weeks, okay? So we can't have that happen to the portfolio. But when it comes to the S&P, what it optimizes out to is a very lenient stop around the 50-day moving average. And it actually has a component in it that when it drops below the 50, it drops the stop below the 50. So sometimes it'll come to the 50 and get stopped out based on the behavior. Other times it'll drop the stop down to stay in the trade. Okay. So why are we risk monitor red even though the S&P was still in the trade? Well, that's because we use confluence as our guide to determining when we put capital to work and when we take it out. So when we see destruction everywhere else, we still go risk monitor red, even though the S&P might still be calling for us to stay long, because we know the S&P is really the last man standing when the markets roll over and break down. Okay. So what I want to share with you today, the information that I want to share with you is that the algorithm ended up getting taken out of this S&P move. And by the way, the S&P was, long right here. That's the carrot that gets long back on the 18th of October. Okay. And it got taken out on the 10th. And then the market went up on the 11th, which happens all the time. I mean, just because it gets taken out doesn't mean the market has to crater. It just tells you that what's happening in here is, the way I would express this information is that it's getting, the weakness is getting stronger and stronger, even though you're looking at an uptrend. Now it's possible that we'll get another risk on green soon. We could get green soon. It could happen. But I'm just telling you that typically when you get that type of an exit, see, look back here. Now let's go look back at this, this signal back here. Okay. So here's another entry point in the S&P, rallies, ends up getting out right here on that gap down. Okay. We were risk monitor red already, but again, this is a little bit late. And it rallies for a couple days back up to the moving average before it takes the rest of the month to consolidate and then give us a tradable rally again. It turned us risk monitor green. It took a series of weeks for that to set up once it gets taken out. And so the information that I'm sharing with you is, yes, it's possible we go risk monitor green again, but statistically speaking, when this finally gets taken out, it tells you that there's more weakness in the market than we actually see, which is hard to believe right now. NASDAQ's going to be up 1% at the open. S&P's up 0.5%. I get it, but I'm just sharing the information with you. And then we read and react. Okay. So let's dive into what stocks are at the top of our whiteboard, because the market's going up and who knows, might have a huge buy signal by the end of the week. We'll put money to work. So let's go shift now to what's working. First of all, isn't it fun to have different styles of management in your portfolio? The ARMR report, we have 4 portfolios, and we recommend, and this is what I do with my own money, that we have capital in each different discipline. Really 3, okay? 1 portfolio is a risk monitor reflection only. All we do is buy the 7 indexes when we get risk monitor green. We cut the positions down when it's yellow. We're 100% cash when it's red. So right now it's 100% cash. All right. The other 3 portfolios, ARMR 1, ARMR 2, ARMR dividend, right? Right now the ARMR dividend portfolio is killing it. So even though we're risk monitor red and we have a lot of cash in the portfolio, we have a significant amount of capital tied up in dividend stocks where the principal's going up. And so different styles of management is what creates the diversification to protect an account and still capture upside. Okay. So let's go take a look at what's working in the portfolio, right? The dividend names, and you're going to see something that's going to dovetail with leadership. Actually, let's go up here. So the names that are really leading in the portfolio are names like the energy pipelines. We bought them right here at the 200-day moving average with a yield of better than 6% on these pipelines, and the stocks are going through the roof. KMI, we're right in here. One Oak is moving, right? EMB. Okay, we bought EMB right down off this double bottom right here. All right, don't forget Exxon. These are the names that are in our dividend portfolio. That was a cup and handle extraordinaire. We bought it right in the base, blowing out. Okay, so don't forget BHP. So what BHP and Rio Tinto are in the portfolio. Those are 10% yields. Okay, and so what I submit to you, obviously, if you look at all those things and say what do they all have in common? They're commodity-backed assets. So if we go risk monitor green, what we really want to do is focus on leadership. And what's leading so far in 2022, even when the market's selling off, these stocks hold up best. It's everything touching a commodity. We started by adding to our dividend portfolio, which we hold right on through risk monitor red because we use different sell signals and different sell rules. And we loaded up that portfolio with energy-backed assets that are going through the roof. Then we look at the rest of the portfolio. What do we have in ARMR Portfolio 1? We have Caterpillar. We're making money in Caterpillar and Deere. These are stocks that touch commodities. So what are we going to look for to add now? And I guess this is the stage where you grab your pen and piece of paper. You could jot down some symbols, start doing your own research on it. All right. Yesterday, we increased our exposure to precious metals again. Okay. So I reduced exposure on the breakdown, and I said to you guys, if it holds up, comes back above the 200-day moving average, I'm going to double or maybe I increased it 50%, my Sprott physical gold position, right, and my Sprott physical silver position, which seems to be holding the bottom here. Okay, so I do have on the whiteboard at the top shares of Newmont Mining. This is a stock paying a 3.8% yield. Now, I don't think it's fair for me to put that into the dividend portfolio because it's really a gold stock. So I'll probably put it in ARMR Portfolio 1. It's not really a dividend stock, but 3.8%. It's backed by gold, and a company has a announced plan to increase that dividend throughout the year. You're probably going to get more than 4% by the time the year's over. It's hard to ignore that double bottom, run above the 200-day moving average, pull back, test it, hold. That's probably a name should be in the portfolio, simply to pick up that yield. But the reason I'll put it in ARMR Portfolio 1 is that I don't think I would hold it through a collapse. The stop is going to be the 50-day moving average on that, which is a little bit tighter than the other stops I'm using. Okay. COPX. That's just, this is the copper stocks. However you want to express a copper play, what this chart is showing you is it's time to own copper. Again, the stop would be a low of the that day right here below the 50-day moving average. So the stop is tight, and at some point, what we're getting here is a classic ARMR setup. This is what we like to look for. We like to see strength followed by a period of consolidation / weakness, which is what we call stage 2, right? And then when you come out of that base, okay, particularly if it holds the 200-day moving average like it's been doing for months, right? Then you get a launch off of that base that can be fairly large. Erez pointed out HMB. That's a sick-looking chart pattern right there, boy. I love that chart pattern. And this is a commodity-backed name. Okay. Here's some names at the top of my list. These are not just commodity names now, but I still want to own shares of MGA. It popped up. It's made a nice tight consolidation. We're going to want to own that before it breaks out. You need to own it right in here with the low of this breakout bar as a stop. So a pretty tight stop. Risk monitor. If it was risk monitor green, I'd already own that. Okay. I still have my eye on Visteon, tight to the base. Boy, I really want to own Intel. That's a perfect ending triangle of a major consolidation as the company tries to rebuild itself. And it has some key components that seem to be working. Of course, the low of this bar right here would be the stop on Intel. Okay. I think if you're ever going to own Boeing, it has to be owned before they announce that they have, free and clear the ability to start selling the Maxes again, which they expect to happen sometime, in the next few months. Who knows when it'll be? But somewhere in here, Boeing's just a no-brainer. All the bad news is out, in my opinion. All the bad news is out. Everybody knows it. So now it's just a question of when they get back on track and start producing planes. And they're already doing that. But I mean, getting past some other hurdles than some of the last hurdles. Okay. Honeywell. We're looking for the tight entry points to the base. Big run, nice pullback, holding the 200-day moving average, popping back above it. Tight to the base. It goes back below the low of that bar, you're out, so the risk is low. By the time the stock's breaking out, we already want to be in it. I'm looking at Lockheed Martin. It's like an ending wedge to me. I don't know where I'm going to buy that, though, but it's on my list. Then we'll shift over to financials a bit. I don't own the financials right now, but I'm looking at JP Morgan. Stage one's the rally. Stage two is the tight base at the 250. It's popped up, making a tight little pennant here. Probably want to own it before it breaks out. Goldman Sachs is the same story. JP Morgan, Goldman Sachs, and Morgan Stanley. Those are the best brokerage firms, and Morgan Stanley just broke out. So Goldman Sachs and JP Morgan are sure to follow. I may not own all three. I might just own the big two. I don't know. I'll have to see. I really want to own the service stocks. The OIH is running away. I'm not going to pay up for these things. And XOP has, blew out yesterday. Again, I'm not chasing these things. I need to buy them on down days. But my favorite, what could be massive growth stocks this year is buying the drilling stocks when they're down, when they're forgotten, when the day rates start going up, when they start increasing CapEx to bring mothballed rigs back on the market because demand is heating up. That's when you want to own these things, not when they start announcing huge earnings numbers. They'll be up here by the time they start doing that. Helmerich & Payne's every single cycle since I've been in the business, and that's over 30 years, Helmerich & Payne's the best land driller. I don't think it'll be any different this time. And I think that gap down here on earnings, because they increased CapEx, because they said they're bringing more rigs out of mothball because demand is heating up, but that's going to hit their margins in 2022. That last flush down, I think that's what we just heard on that conference call. This recovery back above the 200-day moving average and the 50, the stop would be right in here. I think the upside's enormous. And of course, Rig is the offshore driller, the offshore, partner to HP. And I want to buy these things tight to the bases. You can't buy them when they're running. The risk is just too large. So those are some of the names I have an interest in. Find this helpful. I got to get out of here. There's BITF. I'm not a big buyer yet of the crypto stocks, but who knows? Maybe crypto will stop. Oh, great. I'm all fuzzy. All right. Well, I may as well split then. All right. I'll see you guys on the live trading desk in a few minutes. Let's have a great day trading. And I'll leave you on that Bitfarms. Oh, you know what? Don't forget Dow Chemical. Yeah, Dow Chemical should be on the list too. At a 4.8% yield. That's going to go in the dividend portfolio probably today. All right. I'll see you on the flip side. Have a great day trading.